week's first Targets in Focus, I'm joined by Sverre Holbek, Senior Analyst from Danske Bank in Copenhagen. Well, Sverre, the markets are eagerly anticipating the outcome of the Emergency EU Summit on Wednesday. Depending on the outcome, where are you expecting the euro-dollar to head over the next year?
Well, basically, we've seen a euro-dollar rebound almost as rapidly as it's sold off, and we've seen it looking to test levels around 140. I think some of the key factors have been, of course, hopes and signs of the political progress towards a recapitalization of the European banking sector, but also other factors which have been driving the rebound has been the better-than-expected U.S. and also Chinese economic data, helping to ease global recession fears, and in turn causing the somewhat stretched long dollar positioning to be unwound. Going forward, we think that in the near term, we still have to see a more concrete solution to the European debt crisis. So therefore, the Emergency EU Summit tomorrow will be very much in focus and will be decisive for determining the near-term direction for euro-dollar. But we still have no final solution, and also with European economic data remaining on the weak side, as underlined by yesterday's quite poor PMI data releases, it seems like risks in euro-dollar is skewed towards the downside. So we look for, in the near term, we look for euro-dollar to take back some of its recent gains and to head towards 136 and 1 month horizon. Further out, we look for the dollar negative factors to resume. So that is first and foremost the massive current account deficit in the U.S., signs of improved global economic prospects, which tend to coincide with the weaker US dollar, and that should then take euro-dollar to levels around 144 on 6 months and 148 on 12 months.
What about the yen? There's talk of a possible currency intervention by the Japanese authorities. If this is the case, how would this affect the dollar-yen and indeed your forecast for this pair in the short, mid and long term?
We think that the Bank of Japan will act to stem yen appreciation if dollar-yen falls below the 76 handle. Hence, in the near term, we look for the downside to be capped. Also, with U.S. recession fears easing and the recent rebound in U.S. rates as economic data have improved, we think that there should be some catching up to do of dollar-yen to relative interest rates. So we basically look for dollar-yen to trade higher towards 78 in 3 months, 79 in 6 months, and 81 in 12 months.
OK, moving on, I understand you're expecting the pound-dollar to dip down to around 155 in coming weeks, then trade in a fairly tight range over the next year.
That's correct. We look for a cable to head lower over the coming months. Basically, we expect a close correlation between sterling and the dollar eventually to decline. It is currently unusually high, but we think that the divergent monetary policies of the Bank of England and the Fed will be a key factor in taking cable lower. Basically, the Bank of England's decision to raise the ceiling on its asset purchases by 75 billion sterling to a total of 275 billion sterling to boost the economy will be a key factor weakening the pound in our view. And there's also a good chance that the quantitative easing program will be expanded further. It's quite clear that the economy needs more stimulus well into 2012. And even though printing money is the right thing to do for the economy, it is likely to be harmful for sterling. In contrast, it seems like the Fed is on hold for now. It doesn't look like we will get more quantitative easing, with economic growth in the third quarter expected to be quite decent at around 2.5%. So we think that the monetary policy stance of the Fed and the Bank of England will increasingly diverge, and that should be a key factor in taking cable towards 155 in 3 months.
And finally, before we run out of time, what are your thoughts on the loonie going forward, as there is now a bit of concern surrounding the strength of the Canadian economy because of everything that's going on around them?
Yes, if we look at weekly correlations, it seems like dollar Canada is the currency cross in G10 space which correlates most closely with overall risk appetite. So we still think that that dollar Canada will be very much in the hand of overall market sentiment. From that perspective, we look for further improvement in global economic prospects in 2012, and therefore we still think that the Canadian dollar will be on the strong side of parity for most of 2012. So we look for dollar CAD to head towards 0.94 in 12 months' time.
Thank you, Sverre. I'm afraid that's all we have time for today. Tomorrow's Targets and Focus will be a special edition on commodity currencies, so make sure you stay tuned. Goodbye for now.